This is the international arbitrage on February 2024, the 15th of February. And today we're going to talk about the international fundraising for non-U.S. businesses. And so non-U.S. businesses, if you're a non-U.S. business, a non-U.S. owner, operator of a business, a family-owned business, and it's an SME, and you want to raise capital in the United States, and you want to raise it from U.S. investors, then if you're looking at raising the type of capital, say 50 million up to 100 million, and you're looking at more than 50 investors, you probably want to set up an international alternative investment fund in the U.S. This would, for instance, it could be a trust or it could be a limited partnership. But the key thing for you is that the alternative investment fund, sometimes described in the U.S. as a private equity fund, has to be regulated. In the United States, if you're raising under $150 million, you do not have to be regulated. So you're not registered with the SEC. What this means is that you can raise funds, you can be an investment manager, and you are not regulated by the U.S. SEC. So this is not going to work for an international business that is raising money in the U.S. because if you're exempt from the U.S. securities laws, then U.S. investors and their advisors are going to realize that basically they don't have any investor protection. The laws of the United States are not in point, they don't apply, and so therefore they will not have the transparency and the protections of the U.S. regulation that they would need and that they can get, to be honest, in other U.S. domestic businesses. So therefore, what you're going to do is you have to get an SEC registered investment advisory company. That company is regulated by the U.S. SEC. And so therefore, when you hire that company as an investment advisor to your investment fund, then you have a regulated alternative investment fund, because now the securities laws of the United States, under the U.S. SEC, regulated by the U.S. SEC, apply to your alternative investment fund. But there are two things that you have to keep in mind when you are setting up a regulated alternative investment fund in the United States of America. You need to select a registered investment advisor that is registered with the U.S. SEC, but which also is an owner operated, because you don't want a large financial institution which has thousands of employees. You will not be able to talk to the owners. You will not be able to meet with decision makers if, say for instance, their due diligence process or their compliance process flags your business as a high risk because it's international and it's non-U.S. You want to be able to sit down with and explain that to the owner so that he can direct his people to get more of the necessary information that explains the risk, explains the situation, and therefore enables business to be done. Second thing you don't need is you don't need a firm, a registered investment advisor firm that does not know how to or does not usually do with international non-U.S. companies. Now, you as an SME owner operated company might be raising less than $100 million. This in the U.S. domestic market is a relatively small transaction. In the U.S. market, it is small because many investment advisory firms that deal with private equity in the U.S. deal with hundreds of millions, sometimes billions, sometimes quite often billions of dollars. So a small deal, like less than $100 million, means that the investment advisory firm is going to make less fees than they would if it was a larger deal size. But then keep in mind, not only is your deal size very small, you've also got the fact and the fact that the investment manager will be earning less fees from your small deal size. But you've also got the fact that it's international. your business is international, it's outside the U.S., it carries more risk. So you're asking the regulated, as U.S. SEC regulated investment advisor to take less revenues, less fees, and take on more risk. And so this is something that you need to think about managing early on if you know that you want to raise money in the United States of America. So there are a whole range of things that you can do, including contacting a U.S. securities lawyer early on, speak to them, ask them if they know, have contact, and often work with the right firm. That is one way to do it. The alternative is to look for the right firm yourself, but now you have a profile, you're not spending time talking to large companies that are really just a waste of time for you, or companies that are domestically focused. You could be speaking to a registered investment advisor that is based in Columbus, Ohio. Columbus, Ohio has a population of 12 million people and counting. There are firms there that haven't even been able to address that entire market. So why would they take on a firm that is outside of the US, is international? The international aspect of US rules applies to that. It's more risk, and so on and so on and so forth. Why would they take on that extra hard work, extra time, extra risk? These are things that you need to be aware of. Don't waste 6 months thinking that all you have to do is call up the registered investment advisor and offer them a contract and your fees. That's not necessarily the case. A lot of them will turn you down because that business just isn't in their lane. And so that's a very important thing for owner managers of international businesses who want to raise money in the US to be aware of. Don't waste time. Once you're aware of these things, you can plan, take action, and do things in a timely fashion. Thank you.